An average startup can take between 3 to 5 years to become profitable. However, 70 to 80% of startups in Africa fail within their first 5 years, and this is according to multiple experts. Beg your pardon. Profitability is the most popular success index when it comes to evaluating companies' performance, yet startups are allowed to innovate without turning a profit while they figure out product market fit and other business goals. Well, joining me for more on this is Efayomi Carr, the principal at Flourish Ventures. Thank you, Efayomi, for joining me today.
Thank you for having me. It's great to be here.
All right, great to have you too. Well, if 70 to 80% of startups in Africa fail within the first 5 years, then I think we need to start by understanding why this is so.
Absolutely. And I think it's important to understand that while 70 to 80% may fail, an additional, those 20 to 30% who succeed have outsized returns. And so the success stories are small, but mighty. And it's clear that what these startups are doing is incredibly difficult. They're actually fulfilling a really difficult task in a really challenging environment. And so startups can be blocked by regulatory headwinds and by the incredible macro challenges that we're facing in different markets across Africa. So in the face of these difficulties, it's incredible how resilient some of these entrepreneurs can be to still find success.
All right, so when you talk about this, you sort of exonerate these companies, these startups or founders or operators themselves. Are you saying that the bulk of the challenges they face is as a result of regulatory issues or environmental, maybe the business environment not being convenient enough?
Yeah, by very definition, what startups are trying to do is they're trying to create value in the face of systemic challenges. So they're creating businesses when no one has succeeded before, and they're trying to use new and innovative technologies and processes to do that. And so the very nature of the work that startups do is already, the cards are stacked against them. And then if you add the additional risks and challenges of operating in some of the markets where African startups operate, where there can be, as you mentioned, unclear regulation, there can be deep infrastructure challenges, and there can be these huge macroeconomic headwinds that we alluded to earlier. So all of these things really increase the challenges that startups will face.
Right, and that's quite not so good one right there. But then funding is usually one of the biggest challenges. But yet, some industry watchers believe failure is avoidable when there is a tough funding environment. Now, do you share the same sentiment?
Yeah, it's an interesting thought. Fundamentally, startups often will need capital in order to reach scale. And that's usually the point at which they can turn profitable or cash flow positive, and they're able to sustain themselves on their own. In Africa, we've seen that, 2-3 years ago, there was a huge inflow of venture capital. So startups at the early stages were finding enough funders that could finance their progress and their growth. In the last year or two, that funding has really slowed down. So it's been really challenging for early stage startups to attract capital, and it's been incredibly difficult for later stage companies to find additional capital. And so what we've advised our companies is to plan for a low funding environment. It's been really interesting across Africa, but beyond, to see companies reorient their business models in order to reach profitability quicker and have sustainable financing when they are unsure of where additional capital will come from.
Right, and that's quite interesting. And I also know that some persons are talking about founders having to strike a delicate balance between financial planning and also some of the things that could maybe funding availability. What do you think about that? Striking a balance between financial planning and funding availability.
Yeah, it's interesting. So obviously, we would advise our companies that they need to have a viable financial plan, meaning they need to have enough capital to sustain themselves until they can attract additional funding. As I mentioned, in the last 2 to 3 years, it's been incredibly challenging to find that follow-on funding. Many startups are not able to access the capital markets, and many funders have pulled back from venture capital. This is for a lot of reasons. If you look at high interest rates and relatively strong public markets performance, a lot of funders are able to find high returns in much less risky bets. And so that's caused them to pull back from venture capital. Africa is considered one of the riskier markets for investors to go to. Therefore, African venture capital has suffered the worst of many of the ecosystems. So what this means is that no longer can startups rely on capital to come in to fund their startups at the later stages. What this means, many of the startups we work with are now developing business models that don't need to attract as much capital in order to be sustainable. It's really reoriented the dynamics of venture capital and startups in general across Africa. In many ways, this is a positive. It means that we have more sustainable business models, and ideally it means that less startups will fail because of a cash flow shortage, because they've reoriented their business models.
Well, this business model you're talking about, for how long have we tried it, and how successful can we say it has been so far?
Yeah, I think the report that you alluded to describes how even in the last 3 or 4 years, where there's been a really funding environment, both because of COVID, because of global economic challenges, and because of sort of logistical and infrastructure challenges. Even in the face of that, we found incredibly successful startups. We've seen a lot of companies who've been able to grow in Africa and beyond, even with these headwinds. And I think the impact is really easy to see. If you look at, if we're in Nigeria and I can make a payment, I can actually order, an Uber, or I can pay for a flight. All of that is enabled through to a startup like Flutterwave, which is a payment processor. If you look at markets like Kenya, where we've seen incredible environmental challenges, and yet we've still seen farmers being able to access inputs. They're able to get a loan to buy fertilizer and seed to grow, or they're able to access insurance through companies like Apollo and Pula. All these things have been enabled through technology startups. And so it's easy to look at some of the challenges that these startups have faced, but users across the continent are every day benefiting from the startups who have been success stories and who have done it in a sustainable way.
Efayomi Carr, thank you so much for your thoughts. I wish we could talk about this all day, but we need to go now. Thank you for your thoughts, Efayomi.
No problem. Thank you for having me.